What's going on today? Why the sell-off?
Well, with respect to the deceleration in the economy, that has been the forecast for Goldman for some time. We would expect the U.S. economy to continue growing, but decelerating all through the rest of this year and into 2022. And Alix, what that is relevant for the equity markets is that companies that have the ability to grow, we'll call it more secularly, through a deceleration is something that should be prized and should be embraced by investors at this time. In addition, the sharp decline in bond yields really benefits these companies with longer-term growth prospects. So I'd say the two things are working together. Both slowdown in the economy and lower rates have worked together to boost the returns and the performance of some of the big technology stocks in particular.
What I don't understand, though, and even Goldman, even if you see a deceleration, you're still looking at growth with a 6 handle. So it's still going to be a quite strong growth. Doesn't seem worthy of a 1.2% on the 10-year.
Well, I won't speak specifically to the 1.2% on the 10-year because that has surprised so many people, right? The expectation generally among many market participants is that bond yields will be rising perhaps towards the 2% level at the end of this year. But obviously, it's gone in the other direction, which has just been an accelerant for some of the companies with much stronger growth prospects. Ultimately, Alix, this has been a trade about duration in the equity market. Now, most people in bond market think about duration, normally, but in the equity market, that terminology isn't often used. And the idea of longer duration or companies whose average kind of time in the future that those cash flows are generated, those are the companies that have benefited the most from the decline in interest rates. And so those are a lot of the glamour stocks, many of whom are losing money now, but growing their revenues super fast. Now, I think those would be more at risk if rates begin to rise. And so the profitable technology companies is a big area to focus on. So big tech, but the profitable companies. A lot of semiconductors, some of the social media companies, some of the larger tech companies we can think of, those will be the ones to be focusing on. They've done well. They'll continue to do well in a world of decelerating economic activity.
How much defensive versus cyclicals do you have to own outside of, say, the profitable tech companies?
Well, when we think about defensive versus cyclicals, the nomenclature of that is often, you could take a look at Microsoft, for example. A lot of people view that as a defensive stock. It has lots of recurring revenue, the software as a service. Arguably, a lot of those companies have more defensive characteristics than cyclicals. But the idea of a recovery, called the reopening trade, the COVID recovery trade, airlines and hotels, all those stocks have generally had terrific performance this year as more and more of the economy has reopened. So Goldman Sachs, all the analysts at Goldman work together, and there's a index, sort of a lockdown index, if you would call it that, or reopening index, perhaps more accurately. 1, fully locked down, 10, fully reopened. And right now we're at 8. So for a while we were 1, and then it climbed back, and 4, 5, 6, and sort of then for a long time in that area, it's kind of moved back towards we're at 8 right now, which gives an indication that from this point forward, that big cyclical recovery, a lot of that has already been priced in and traded. Now we want to think of what will do well in a decelerating economy as you look into 2022. And make no mistake about it, most portfolio managers are focusing on 2022 earnings. Even though we're just getting the second quarter of 2021 results now, most people are looking forward. Meaning
that second quarter growth, the 6 handle you got to take with a grain of salt, for example, because we're backward looking. So what does that mean then for small caps?
Well, small caps generally were more leveraged to the economic recovery, but they also tend to have weaker balance sheets, and there's a lot of concern on the part of the investors, the ability for some companies to have ability to absorb higher input costs and a margin front. And I think that's where some of the larger companies have more flexibility, if you will, more levers to pull in that environment. One of the central areas to focus on, in my opinion, our recommendation, is to focus on companies with the ability who are forecast to be improving their margins, whether that's measured as gross margins, whether it's net margins, different ways of thinking about companies. There's a lot of higher input costs, whether that's labor costs, whether that's raw materials, whether that's for transportation, hiring people. The ability of those companies that are better positioned to do that would be likely to outperform. And that's where it comes back to your question about small caps. I think the larger cap companies have more, if you will, levers to pull to absorb the input costs.
So on a day like today, then, does it feel like it's a growth scare, but one that you saw? It's like a growth scare we knew was coming?
Well, is that knew it was coming? Would like to say we're clairvoyant, but no, I think it is surprising. There's no question getting up this morning and see 10-year Treasury yields on a nominal basis at below 120 is certainly surprising. It's not been the general belief in conversations with most people that have the view that rates are likely to go higher. So that's that has been a surprise. Whether they call that a growth scare or not, I think basically the fundamentals are the economy is growing, revenues are growing. If you want to think about the story in 2022, the real risks right now, one is rates. Prospect is from this point forward, perhaps go higher. Taxes, both corporate taxes and also capital gains taxes. Those are your big risks. As we sit here in the next sort of 90 days, the dominant narrative is going to be the Washington, D.C. discussions about higher corporate taxes. And that, Alix, is going to lead to negative earnings revisions across most of the market in the last part of the year. Our forecast is that earnings for next year will be about $202. Consensus right now is $212. Basically, most analysts have not embedded in their forecast higher corporate tax rates. And on top of that, you have to think about higher capital gains rates. And when capital gains rates have gone higher in the past, that has typically been associated with lower valuations. You got earnings and valuation, two transmission mechanisms of why they're cautious on the overall market and why we'll be around 4,300 at the end of this year, given our interest rate forecast.
So one more quick question on that, and this actually has to do then with the back half also. Companies have a ton of money on their balance sheet.
Yes.
What do you think they're going to do with it? And then what's the investment thesis because of that, particularly if they're not prepped for higher taxes, for example?
So what are companies likely to do with it?
Yeah.
Mergers. We've seen $1.9 trillion of merger announcements year to date here in the United States. So that's a kind of record level of dollar amounts in terms of through the first 7 months of the year or so. If we think about companies looking forward, that's likely to be absorbing a reasonable amount of their cash, number one. Number two, concerns about antitrust will cause, in my opinion, managements, boards to kind of reflect on, are they likely to get approval from the government for these? And they may be cautious, and that would, if you will, tilt, Alix, more spending on the margin towards capital spending, CapEx. That's in organic growth by themselves, growing the business, as opposed to kind of bolt-on acquisition. So I would say the risk on a regulatory front would be potentially a headwind in terms of the amount and pace of mergers. On the other hand, the amount of cash is quite significant. I think at the end of the day, from a strategic point of view, you perhaps will have a slight shift in favor of the private equity bids in the market, private equity purchases, as opposed to some existing corporations where I think the antitrust is a significant variable and uncertainty in this environment.